All right, Bian.
Okay, Alone will be presenting a random walk down Wall Street by Burton G. Malkiel. All right, go ahead.
All right. So this tonight's book is goes hand by hand with the previous book we read last week. The Armchair Millionaire. It's the same concept. So without further ado, I will start. So, the author Burton Gordon Malkiel was born August 28, 1932. He is an American economist, financial executive, and a writer, most noted for his classic finance book, A Random Walk Down Wall Street. The book was first published in 1973 and is regularly updated. The version that I read was updated in 2015. The core message of the book is that most investors cannot consistently beat the market, so invest passively and wisely. So he talked about a random walk theory, which means that stock prices moves unpredictably like a random walk. Past price movements don't reliably predict future performances. In other words, prices move in a random, unpredictable manner. Past prices movement and pattern do not reliably forecast future prices. So beat the market, trying to beat the market through timing or technical analysis is futile for most investors. So, investment psychology. The markets are influenced by the crowd behavior and the emotion. So, avoid speculative bubble driven by hypes. He gave example of a tulip mania or dot to come boom. And I went ahead and searched a little bit about what tulip mania is, and it says that I think it's in Netherlands. Hold on, let me go ahead and read it for you guys. So the tulip mania is a period of speculative frenzy in the 17th century in Holland where the prices of tulip bulbs skyrocketed before it crashed drastically, right? And when I go to look at the dot to come bubble, it was also a speculative stock market bubble in the late 1990s, driven by the rapid growth in internet company and venture capital that peaked in March 2022 and burst by later 20 March 2020. I mean, I'm sorry, March 2000 and burst later 2002. Okay, so it's kind of like everybody go and put their money on one thing, and later it's kind of crashed down and the people lose their money. So
Investment.
two investment theories. The first one is a firm foundation theory, which is based on intrinsic value, and the second one is castle in the air theory, and that one is based on the market psychology. They also kind of criticize both and recommend that people uh, invest more, use a balanced approach to their investment. So efficient market hypothesis. Here he said that the market reflects all available information and it is nearly impossible to consistently outperform the market through stock picking or timing. And he went on and give a lot of detail about that. So that's where he talked about the power of index funds, right? He advocates on low cost diversified index fund. So the power of index fund according to Malkiel are the first one is a superior long-term performance, right? Over time, the index fund always outperform most actively managed fund. And studies has showed that about two-thirds of active managers underperform the market each year. And those who outperform one year often fail the next year. So reason why other reason of the power of index funds, we have a low cost fee. Index fund have minimal management fee because they don't require active stock picking. Lower fees mean more of your return stay in your pocket and compounding over time. Broad diversification. Index funds typically hold hundreds or thousands of stock, reducing risk through diversification. This protects investors from the poor performance of any single company. Simplicity and transparency. Easy to understand. They track the market index like a S&P 500. No need to analyze individual stock or time the market. Index funds are efficient market exposure. Malkiel argues that markets are efficient. Price reflect all known information, and he previously said that. Oh, hold on. Hold on. Okay. So index fund gives you full exposure of the market performance without trying to beat it. And ideal for passive investors. So, and this is the idea of the uh, armchair from the armchair book, right? Perfect for those who wants to buy and hold on to it without constant monitoring. Encourage long-term discipline and reduce emotional decision making. So you invest, you go sit in your armchair, and it keep growing for you. Risk and reward, right? Risk is inherent in investing. So risk and investing goes hand to hand. That is the risk level that exists without any control or management action in place. So when you put your money in the market, it can perform well or it may not perform, right? So there's always a risk there that nobody has control over. So he's advising to use the modern portfolio theory to diversify and balance risk across classes, right? So diversification, basically he's saying don't put all your eggs in one basket. There are multiple index funds out there that you can put your money in, but don't use only one. Index funds are recommended for long-term investors. So that's comes repeatedly. And risk and portfolio. So we already talked about the modern portfolio theory, diversification, and risk tolerance, right? So when you put your money in the market, it can go down or it can go up. Sometimes it go down drastically. Like last Friday, the markets kind of sink down more than usual. So if your heart cannot tolerate that, you may want to choose the one that has lower risk. But if you feel like, okay, it goes down, it will always goes up, and your heart can tolerate that, you can choose the one that has higher risk and a higher return as well. So your risk depend on what you can tolerate. So here he gives some advice on what to do per age group. So when you are in your 20s and 30s, he suggested that you put more of your money in stock market and fewer in bond, right? In your 40s and 50s, he wants you to balance both. And when you are above 60, he wants you to put your money more in bond, fewer risk, and fewer in stock. So depending on your age, you can choose what applies to you. So behavioral discipline. So avoid emotional decision like panic selling or chasing trends. Stick to a long-term plan. Rebalance periodically. Okay. So final takeaway from the book is save regularly and invest early. Don't wait too long. Favor simplicity and be patient. Let compounding and time work for you. And that's the end. Thank you so much for your attention. And the time is for question and answers. Thank you.
Thank you.
Thank you.
Thank you. I'm gonna go first.
Okay, Bia.
Okay, first I want to thank Mom for the great presentation. And what I learned from the book is how it explains theories and its and their histories and phenomenons and why the events happened. And it doesn't discard that you can beat the market sometimes, but it's a random event, and the best thing to do is to go with the market for the long term.
Okay.
Okay, thank you, Bion.
Thank you.
Understand.
So Bion, you're the master of ceremony. Do you want to lead?
Yeah, you have to.
Does anyone else have anything to say?
Yeah.
Yeah, you don't want to see them.
Oh, what do I do? Stop sharing.
No, go to the Google and we can see them.
Yeah.
Go, yeah.
Okay. All right.
Just close this. Close that thing down.
Oh, la division
Don't worry about it. Was big before. Just
before.
close that one. Close this thing.
Okay. Anyone has a question? Anything that they want to say?
So I have a question. Like, what is a balanced approach? When he suggests to use a balanced approach, but the question is for you and for everyone.
Okay, for me, balanced approach, the way I understand is probably half. You want to put half in stocks and half in bond. So you can have a 50-50. For me, that's what I understand, because before he said more in bond, so you may do 70% in stock and 30% in bond. But as you are in your, what's that age, 30 to 40 to 50, he wants you to do balance. So for me, the way I understood is a 50-50, right? And after 60, you can do 30% stock market and 70% bond. So, you know, you have more of your assets in a low risk investment.
Okay,
I don't
thank
know
you.
if anyone has anything else.
Hmm. Anyone else?
Let me
I,
quickly go. Can you
Okay.
hear me?
Yes.
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 Yes, we can.
I think this book is really, really complimentary of what we read last week. And before that, I had to thank Sister
Mhm.
Colomb for the presentation. And I'm proud of her. Why? Because right now she's no longer afraid of saying diversification, indices, and all this because of this club. So I'm very, very proud of you.
Yeah,
But after
that
reading
is
this
true.
book,
You.
after reading this book, it opened my eyes that even though that I'm in that field, is that a lot of people cook the book just to show that their company are making great. And it's not difficult to do it. It's not difficult at all. Why? Because if you buy a car and instead of saying that that car is 50,000 and you want to expense, you are supposed to expense them, but you decided to put it as an asset, immediately your profit goes up by 50%, up by 50,000. So it's so easy. So in that sense, I think we who cannot control anything at Wall Street, is better for us to go for indices, because the indexes is kind of for insurance for us. And if you buy, let's say that you buy ABC stock and you forget about it, that ABC at one point they might be telling you, oh, come and sell it because it's going to zero. And it does happen. Like OPI, the stock OPI was maybe 2 cents, and later it disappeared or from the market. Why? Because maybe it's bankrupt, or maybe they decided that it's too low that they cannot how say it again on the stock market. So all these things, sometimes we forget about it. So it's better that we put our money into the index, and the professional will be checking it all the time to see whether it's going. If there are 10 companies that are not doing great, they will fall off from that index, especially the 500, the SP 500. They will fall off, and 10 more, 10 new company will replace them. So it's kind of our protection. I want to go for the other question, whether for the asset allocation. I don't know if it's in this book or in another book, but usually they advise you to take 100, and then you take your age. Let's say that I'm at age 10. I will take 100 minus my age is 90. So at that age, I can go for 90% to stock market. If you are 20, you take 100 minus 20, then you can go on the stock market up to 80% of your money into the stock market. And the difference of 20% is going to be the bond. If you are already 50 years old, it's like 50-50 at that age. If you are 60, then you start, it's going to be 40-60. So it's the way certain people advise to do the allocation how the asset allocation, the stock and bond allocation. So it's in that mind we can remember quickly that
That's
okay, our 100 minus the age is where we can invest into the stock, and probably our age, real age, is the bond. So it's kind of insurance there. And the other part is that we cannot
awesome.
control
Yeah.
the
That's
the
more
That's cool.
practical. Yeah.
yeah. Uh, what I learned as well is that we cannot control the population, the people on the market. Anything can happen, anything, and also
Mm-hmm.
sometimes they are even, I don't know if you guys hear about GameStop, GameStop stock, GameStop stock.
Yeah.
Okay, it was during COVID-19 time when the Gen Z, the youngster, decided to punish the old people on the Wall Street. And the old people, those who have a hedge funds, they normally shorten the stock. And shorten is just a way to say we normally advise that, oh, buy low and sell high. But short is the opposite, is buy high and sell low. So how do they achieve that?
Wow.
Yeah, they will go to the how to anyone who has those funds, those stock, and say, oh, that Tesla is now 200. Can I borrow it? Can I borrow 5 stocks from you with maybe $2 per stock? I want to borrow them. And when they borrow them, they will start feeding bad information about Tesla. Oh, Elon Musk is not doing great. Oh, he's doing that, he's doing that. And then the stock price will start falling down. And it falls down maybe to $20. Is at that time that they say, oh, okay, I'm returning the 5 stock that I bought, I got it. I'm returning them, and now it's 20. So they are making the 100 minus 20, they are making the $80 on that one. Oh, we lost them.
Maybe.
No, we are
I
here.
lost them too.
Okay. Yeah, it seems that they're they're off from the screen.
Okay, so I will continue. So what the GameStop people were doing when the Gen Z want to punish them, they were artificially holding the stock up. The professional were saying that, oh, the GameStop stock will go down, but those Gen Z, they were artificially propping up, trying to hold it up, so that they at that time they were thinking that the Tesla, maybe we take a Tesla, but it will go into 20. Now it's no longer going to 20, it's going to 2,000, 3,000. And those were so why am I saying that? Is that we cannot control anything in that market, to be honest. Most of the time it's going to be by luck that we will get it. But why should we put that luck in why not put the luck on our side by just going for indexes? And I'll finish on this one by saying the quote that Isaac Newton says. He said, I can calculate the motion of heavenly body, but not the madness of people. You cannot predict the people. The madness of people, you cannot. Even Newton just throw the towel in that one. On that one, I thank again this club, and I thank Colombe for her presentation. Thank you, Lord.
Thank you.
Thank you too.
Thank you.
Okay, does anyone else have anything to say?
It seems we lost Colombe and Fred
They're
Thomas.
back.
Oh, they're back.
Ah, Okay.
We're back. So, let me just pitch in a few minutes. I thank Colum for the presentation. And this book is kind of complementary to the one of last week that we read. That market is mostly driven by emotion. It's not something more logical. People just get frenzy and they do what they want to do because they hear something and they make a decision. And most of the time, it's not rational. So, and again, I thank the club for the opportunity for the new wording, the verbiage, the new stuff that we are
Yeah.
learning, right? So, key word for me from the book and the presentation is most investor cannot consistently beat the market. So from that word, like the book say, and last week also, Narcissus is the same thing from that armchair millionaire is it's better to go with the index to follow the market than to go with stock to be the one who gonna lead the market. So to go that way is good, but better to go with the index. The second thing from that is also is as for right now, investing on the stock market is kind of open market. We don't need a manager for our fund. We no longer need that. So if we are using a manager for our portfolio, it means we are just wasting money because I think we have already 3 books telling us that the manager don't beat the market and the index fund at the end perform on the long run better than the physical people. So we're just wasting money by paying them and then losing, part of our investment. So to not use any, and other than active manager, no for that. I already asked my question for the balance approach. Maybe usually my comment is always whatever we are saying, whatever we are doing, get an abstract and do something about it. Don't read and don't read and don't keep reading. You got to do something from your decision making process. And I would like to thank the club because the last week from the Armchair Millionaire, I went ahead and attached the HSA that we're using for the family with a brokerage account in Merrill Lynch because the HSA, our HSA is with Bank of America. But I haven't invested the money yet. But at least I opened the brokerage and everything in process. I thank you for that. And also, Shrel also ended up opening his brokerage account and start investment. I think today is your first day on the market, and everything was just green. So I don't know if you want me to disclose or not, but I thank the club
For
for
that.
that, right? If even 10 years from now or 20, even if maybe we don't have the club anymore, but you remember this club, it was from this. Usually we are the one to push Shirel, right? Or we want to do the, but at this case, Shirel is the one to say, no, that we need to open it. It's time to open it, and we open it, and then we feed it. And yesterday he invested. So
Yeah.
again, thank you very much for the help and the progress we are making. And thank you.
All right, thank you.
Thank you.
Thank you.
Anyone else?
All right. So,
Yes. So mine is mainly question. Even though I have a fair idea of these principles, and we all tend to choose index fund over other category of investment. It's, I still I still have a question between to clearly identify index fund, mutual fund, and ETFs. And if anyone could help, you know, put in try and put it in a layman terms.
Say it again. Index fund and
I said,
what?
if
mutual
some
fund.
mutual fund, index fund, and ETF, explain it in the most simplest way and in the layman terms. I will appreciate it. And the explanation should go explain in contrast.
Well, I think for me, I will ask Arun to explain it because he's the most financial person in the group.
Let me say something before Nasif corrected.
Okay, Thomas, go ahead.
So, index first, right? Index is like when we take the market, we have a stock, variety of stock, but we have them also by category, right? We have them like in finance sector, we have them in medical sector, pharmaceutical, industry, yeah,
Industrial.
industrial, right? So variety. So usually people just buy a stock, any stock, right? You want to pick maybe some in technology, some in medical and all of that. But people they found later, and I think Bogo was the father of indexing, ETF indexing, right? They found it's better to just follow the trend of the market than to lead the market. So what they did is they put many type of fund together. I mean, like let's say the S&P 500. That one is the variety of everything by capitalization. It has the 500 best, and they call it. That's one group, and you have what I did.
So that is called
It's
what?
a S&P.
Okay, so if you I want to talk general first before I go to the index
Specific.
because if you take the ETF, the one that is low cost armchair that you are recommending in the book
Yeah.
are the ETF, right? That's the ETF. That's the one. But you have index fund that are also mutual fund that are managed actively managed by some people, right? So this book, what it's asking us is not only to go with the index, but they want us to go with the ETF. I mean, exchange trade fund or something. The definition you can
Yeah,
look at.
a state traded fund.
Right. So that one is the one that there is no physical people assigned to it on the like on the market to follow everything to do this. They just follow the market trend. Which company are doing good and which company are doing mediumly good and stuff like that, and they rate them. If you take the VO, for example, that is an ETF. So they will look at, okay, these are the best 500 company capitalization on the market, right? And they will see, okay, maybe Nvidia, according to how people are behaving, Nvidia might be a percentage, Apple is the percentage, Microsoft is Meta, Google, and stuff, and they have all of the 500. Some of them might be 6%, and some of them might be 0 point something, some might be 1%, and they have it. Now, according to what is happening, how people are buying and selling some of this stock, they will change the percentage. And that's why if Trump and Elon Musk get in trouble, and let's say Trump said tomorrow he wants to deport Elon Musk, and they continue, the stock of Tesla might start dropping, and the people who have that stock in the index fund on the ETF, they will look at the rating. It cannot carry like a heavy percentage. Other than that, it would drag the fund down. So you have to. So even if the people who invest are not doing anything, but the people who manage the ETF, they have to follow what is happening to drive the fund to follow that trend. So at the end of the day, most years it will be positive than negative. So I don't know if I say too much, but that's ETF. But now ETF is kind of a mutual fund that's a low cost. But the other one also, index fund, is the one that you have some people that manage for you for a fee, and their job is to pick the best of the best. Unfortunately, we are learning that they don't beat the market. So it's up to each of us to go with a managed fund or not. Now, a mutual fund, I'll leave it to Nassif to define the mutual fund.
Charlie, did you understand a little bit?
If I'm not more confused than I was from the beginning, I get it. I ended up getting the explanation that he has given as the way I was, because I understand them as he's saying when he takes one category and explain, yes, it becomes clear. But as soon as it changes to another category, then it becomes
So let
muddy
me
again.
give me 2 more
Mhm.
minutes. Give
Okay,
me
please
2
go ahead.
minutes. Go back.
Take
Hold on, do
take
it.
my take my
Um,
my 4 minutes and explain.
okay, go ahead
Give
then.
me 2 more
Otherwise,
minutes. So
Mm-hmm.
I just pick the VOO because the VOO is not by category, it's by market capitalization, is by the how the market is. If you pick something, let's say technology, then you have Apple, Microsoft, right? All of the people, the Nvidia, some of this. So you have an ETF that track the performance of those. It might not be 500 company, right? It might be some number that they define in that fund, and they track that category. If you want, you can buy like ETF for index fund for a health insurance. And you know, health insurance, almost they're never going to bankrupt in this country, right? Because they're gonna always cheat on people, deny claim, and at the end they will make money. So it's up to us to say, okay, my index fund, do I want to be with the 500 that is the most best 500 company in the country, or do I want to go with like medical supply group, or do I want to go with general insurance, medical insurance? Everything has an index fund ETF that is attached to them. If you want to go, you go with
Thomas,
gold. Mhm.
you are interchangeably putting ETF and this fund together.
ETF
So
is a kind of index fund. That's what I'm saying.
okay, can I jump in?
Yeah.
yeah. Yeah, come clarify, please.
So
Yeah, I know too.
all three are almost the same. The
Okay.
difference is sometimes the management fee. When you take mutual fund, it's like a private people who get together, or let's say we can take the example of Warren Buffett from his company called what's his name?
Berkshire Hathaway.
Yeah,
Yeah, Berkshire,
Yeah,
yeah,
Berkshire Hathaway. It's
Hathaway.
kind of a mutual fund because he's telling you, come and bring your money, and then we can get together and invest. Because in that way we will have a power, and because his idea of inviting everyone, most of the time the management fee is expensive. It's very, very expensive. That's one reason why people always say to you, try to get far, far, far away from the mutual fund
Mhm.
because it's expensive, the management fee. Now we understand between all three is the mutual fund that is expensive on the management fee. But sometimes they pretend that they can get good idea, blah blah blah. If we take the Warren Buffett into account, because he's making sometimes 70%, 20%, 35%, which is more than what the stock market is doing. Usually SP 500 is doing 7 to 12% a year, but he sometimes he beat that. So we let that mutual fund. Now the index is the same thing, but here is the machine that are doing it. And the difference between index and EFT is that EFT, you can go to the market,
ETF.
ETF, sorry,
Mhm.
ETF, you can go to the market and buy it anytime. You can see the price at $10, and 20 minutes later is going to be 12, and 40 minutes before it closes, it's going to be 15. So it fluctuates during the time. The
Like a stock.
ETF, yeah, like a stock. ETF it fluctuates. But index, what you see in the morning is like that till the closing time, because they technically are not trading on the market, but is when everything is closed that they will readjust their thing and say, okay, we normally have 20% of NVIDIA. Now that NVIDIA is this, we have to bring it down to the, and they will do their adjustment at nighttime or during when the business is closed. So that's technically the difference between all three. I don't know if I can I clarify, or if Charlemagne has some specific question, then I can go ahead and explain.
I'd like to
Explain
confuse.
mutual fund first. No, you can explain mutual fund and only mutual fund without the comparison. Fred Thomas explained ETF and only ETF without the comparison. And then we will compare mutual fund with index fund, ETF with index fund.
So, so we're gonna get confused. Why I'm saying that? Because the ETF are also mutual fund, but like Nassif say, the ETF, if you take like VOO, VTI stuff, you can trade daytime. Okay, if you take many times you can trade the VOO and other guy. If you take the VTS AS, the one that Jill Collins advised, the ETF that he talked about, that one you trade only one time a day on your account.
Which is at night.
And this is when the market close. Really, that's where they do whatever Nassif just explained. And that has a
Okay.
higher,
Can we start?
a
Can
higher
we start
fee.
only with? Can we start only with mutual fund and explain it? Because I know that they are not exclusive. I know that all of them are combined.
So
Let us define. Let us explain only mutual fund.
if we
How
don't
could you
go to
explain?
internet, if we don't go to internet and we don't go to AI, mutual
Yeah.
fund, I would say is kind of when you invest, but someone is in charge of managing the money for you to pick the stock. They look at the trend and they'll feel like this is the way it's gonna work, and they have a lot of commission on it. That's my definition.
Is a
Do you have
yeah,
any contribution to that,
yeah,
Fred Adol?
yeah, is what I want to say. It's like mutual fund is exactly what Fred Thomas says, but this time I want to add that is a professional manage. We can put it in a quotation mark. Is a
Yeah,
professional
coach.
manage. They will come and tell you with a white shirt, say that, oh, I know the real stock to pick, but we know by reading all these books that is BS.
Not true.
Technically, it's not true. So mutual fund is how pull the money together so that it's high, is a big money now. Because if you go to somewhere and you have 1 million, you can go and negotiate. But if you come with another 99% or 99 people, so that is now 100 millions, I think your negotiation power will be different. So it's sometimes what mutual funds sell, say that, oh, they can make more money, like a hedge fund, like mutual fund. All this one, they are in professional
So,
managed fund.
so one mutual
Mm-hmm.
fund is
Mm-hmm.
how you call the guy, Madoff.
Mm-hmm. Made of no.
Stay away.
Okay.
That's a Ponzi scheme.
Madoff was not mutual fund.
What he
Okay.
was?
Oh, he
Was
was
the hedge
a
fund?
Ponzi scheme.
Yeah, it's the Ponzi,
Mm.
but he was on the
But it
market.
was
People
on
were
the
bringing money
mutual
to
fund.
him to
So
invest.
No, Everything can be, and then Ponzi scheme. He put that one as a front, the business, the front business, but he was doing Ponzi scheme. It's like a pyramid club. You come with 1,000 and you bring two more people, then we give you 500. And those two people has to bring another two other people so that they can collect their 500. And then you all move a little bit ahead on the ladder, and then and that's it.
Okay,
If you fail,
I beg you guys. So if we could try and then these terminologies are they sound simple, they sound interesting or easily understandable, but they are not that easy. So with the explanation that Fred Thomas gave, what you gave, could we say that mutual funds are funds put together, used to purchase some stock or use and invest into certain things specific, monitored by people who believe they know how those things are behaving and follow it up, decide when to sell it or when to keep it? Could we just say that?
yes.
Yeah.
Okay, perfect. So let's go to the ETF.
You wanna go first or should I go?
Thomas.
Yeah.
Thomas,
So
go first.
to confuse
And
you a
the
little bit again.
teacher will clarify.
So the ETF is a kind of algorithm based to follow a category of stock, not to lead, but to follow. And that's why I confuse you to say it can be by, like, if you want to do communication, if you want to do healthcare, insurance, it depends on what you're interested on. If you want to do mineral, you have ETF almost for everything, right? And you have good company who are performing well, and you have some other company who are declining. So the ETF manager, the group who hold it, it can be Vanguard, it can be Fidelity, it can be Schwab, the group who hold it. Even for the same ETF, Vanguard has its own, Fidelity has with another name, and they track the same type of stock, right? But each group gonna define, when I take like the S&P 500, like everyone know that ETF, right? When you go to Fidelity and you want to invest in S&P 500, they have a name. It has a name. If you go to Vanguard, it's called VOO, right? If you go to Charles Schwab, it might have another name. Each group has their own name. But what they will do is the 500 best company in the US, we know them, right? And market capitalization. That's what they all want to. But the fund, they want to invest by assign a percentage of. Then when you take 100%, they'll look at which one gonna carry the heavy load. That's why they're gonna define by percentage, and they will invest the money that way to follow all of the 500 company. And if there is a change in trend, also they will change. So the same way Vanguard will be doing, Fidelity will be doing the same thing. They might have, the result might be slightly different according to the percentage that they assign, but they're all following. If we just stay on S&P 500, if you go online, you can find the 500 company that in that group, right? And so now if you invest, like Nassif said earlier, all day long you can invest, but you can have some tax complication if you are selling and buying and do day trading, some other. We are not going over there, but you can buy anytime you want during the day. You can place according to the price. If it drop or it's up, it's up to you. You can buy, and you decide also when to sell. And the group who manage, if you buy the VO, for example, the same thing apply to any. They have some fee that is attached to that ETF. They have some fee, and most of the ETF, if you buy from the owner of the ETF, you can buy fraction. You don't need to buy whole. But if you want to buy the S&P 500 and the ETF that Fidelity has, if you want to buy it from Vanguard, you have to buy like 1, 2, 3. You cannot buy point something and stuff like that. I don't know if I confused you a little bit more. I have an
It
answer.
is okay. It is okay, but it needs
That's
a
something
bit
that
more of
says us.
clarification.
ETF, all what he says is correct, but
Yeah.
ETF,
Yeah, I'm doing something.
yeah, ETF is almost like index,
Mm.
but the difference here is the way they package it and the way they open for business. Index, you might have the 500 that the 500 companies, first company in America that to had its ETF and also has its index. That's most of the time the confusing part of it.
Mm-hmm.
You will see ETF of the five first company even sell by the same company. Vanguard might have both. It will have both, but you have to consider the fact that if it is simple index fund, you cannot trade it the whole day. You trade it, even you give orders that, oh, I want to buy, they might not buy for you till the business is closed for the index. But ETF, automatically that you initiate, they will buy for you at the same time, almost the same time. So that's the difference. And also, now we can come with the management fee, because I think that is one of the Charlie's question is here, is the management fee. For index, most of the time they put it as a small, small package, like a $50, 100, it depends on each company. But ETF, sometimes you have to have at least 1,000. You have to have 2,000. And some
Oh,
of the company,
that's
go
the
ahead.
opposite, right? That's the opposite you say. The ETF
Compared to
is the one
index.
with the low, and the other one is the index is the highest.
Oh, is it? Probably.
So let's just say that just stay with Vanguard.
Mhm.
The index for S&P 500 is VTS AS. No, it's VTS AS for the S&P 500, and you need like 3,000 minimum or something to start with them.
Mm-hmm.
And the ETF is VOO for the 500. And then for the
Let me.
VOO, you can buy fraction. So, and the expense ratio for VTS AS will be higher than the one for VOO. VOO will be like 0.03 or something, and the other one will be 0.09.
You still have a
Okay.
confusion, Charlie?
Charlie's a
Yes. Yeah. When you
I think
okay,
too,
so in
to
short,
avoid
can
all of
I
the
say
trouble.
yeah? Can I say that an
Go ahead.
ETF is a pool of securities that is treated like one security. Instead
Oh,
of saying security, let's say stock. Pool
yeah,
of individual stock. It may be 10, it may be 20, it may be depending on what whoever is going to manage it put together and then use that as one stock.
correct.
Can we call them ETFs?
Yeah.
It's the way they do it.
Okay.
Now,
So
if you want to
so
follow,
yeah, go ahead.
I mean, like if you take an example, you want to follow the whole US stock market,
Mm-hmm.
there is an ETF for that. Like you buy just one security, like you say, but you hold
Yes.
all of the stock on the market.
All the stock on the market.
Yeah.
And then if you want to, there are ETFs that are in, you mentioned, for example, insurance, you
Yeah.
mentioned technology. So people take all the possible stock in technology, put them all together, and sell them as one stock.
Yeah.
It
For
is often the
ETF, yes.
fraction of it that is sold because you cannot actually make it all together in one and then sell it and it will be too big. So fraction of it, but is all together sell as one. All together sell as one, and they call it that all the security are pulled together and traded as one security. While mutual fund is rather the fund
Correct.
that is put together to go and buy this stock, which is a specific stock. And the fund could be put together and then also invested into this specific stock.
No.
It could also be pulled together and invested into pool of stock and
Okay.
this and that and so on. Yeah,
Yeah.
I want to make it.
You don't have any control.
Yeah, we don't have any control. But in short,
So-
money, when we talk about mutual fund, it talks about money. Fund, it is put together from various individuals, and then a professional, a stock manager takes it and decide I can put this into this one, follow how things are happening, pull it out when I feel I should pull it out, put it in here and so on. And the fund is the mutual fund invested into a stock that are actively most of the time managed by a professional. That is the mutual fund. When we come to ETF, it is no longer fund. There are stocks that individual put together, and then instead of them being one stock, they put a pool of stock together and they exchange them as one stock. People could decide and buy and or not buy, and they are most of the time passively managed, which means that they are not controlled and changed or regularly. Could we make it like that?
Yeah. So the ETF, they don't charge you that much.
Yes,
The
because
ETF,
it is a lot
they
of
don't
them
charge you that
together.
much.
Yeah, and sometimes there are vehicles. I don't want to go into the jargon. I'm just trying to make it the simplest possible. ETF pull all insurance security together and sell them as
Not,
one security. Or
yeah, not
I'm
all
just
the
giving
one
an
they
example.
select.
Or
They can
yeah,
select
a
50.
number. Yeah, they can select a number of security in a category put together. Instead of you going and buy them one, which makes it complex, somebody put them all together and make them just one. It may be 20, it may be 50, it may be 100, it may be 1 million, but sold as one security.
One. Yeah.
Okay. Yeah,
Okay,
say
but
something you want if you want.
you say something, but you didn't repeat in the last sentence. Is like is shared as well. It's no longer
Yeah.
when you say yeah, and also sometimes most of the time what they use is the weighted average. Weighted average means that if that company holds 20% of the total, they will tend to buy 20% of his stock. If the company hold 10%, they will buy it. And when they finish everything, now they will divide that one and say, okay, by dividing, it's come to $10
All of them.
per share. And
Okay.
also it depends how many they divide to, because it's like a share of a company. Technically, they brought it together, but now they are divided. If they they decided to do it as 1 million share, the price will be different if they decided to do it at 10 million shares. So that's one. Sometimes they might tell you that it's the whole company, whole American's company, but the price might be $10. The price might be
Yes.
$20 because it depends on each company how they do it. And it's like a chef. They give you each ingredients, but when you cook finish, you might be saying that you are cooking pizza, but
Yeah.
the taste will not be the same. That's what is happening with each different company. Vanguard will cook 500 company, but the taste will be a little bit different because he valued this one more, he devalued this one, that, and what normally happen.
Okay. Perfect. So in short, we have a traded exchange or the ETF pool of a stock sold as one stock. we could say that if we want to stay in technology, for example, we could say that Microsoft, Apple, and any other technology, they are all put together. And instead of you going to buy Microsoft, buy Apple, buy this and that, then all of them, they put them all together, and the whole a pool of fund become $1 billion. They divided it into 1 billion and then sold them each as $1 as unit. And we are buying them as 1 unit of stock. Is that okay?
Mhm.
Yeah,
Okay, so
yeah,
yeah,
but
go ahead.
when you go that way, like if you
Mhm.
pick an ETF for a
Mhm.
sector, like say technology
Mhm.
only,
Yes. Mhm.
when technology bursts, you
Mhm.
lose. You can continue. I just want to,
Yeah, I
if you
agree.
pick,
And then there are ETF of technology, there are ETF of insurance, ETF of medicine and medical equipment, ETF of all three, four together, ETF of all the